has been I would say, a seismic change in the world of credit scoring in the U.S., in particular around mortgages, late last year with the introduction, or the allowance, I should say, of VantageScore as a competitor to, call it the stalwart credit score of choice, FICO, for many, many years, well, I think we can say decades, in fact. And this has caused, I think, a lot of, well, at least from my perspective, inbound questions around what this means, how to interpret this new player, VantageScore's credit score, in this very large and important segment of the capital markets, the mortgage industry, and what kind of risk interpretation, calibration, or recalibration might have to take place as a consequence of this new competitive credit score, force in the call it mortgage manufacturing process, from origination to aggregation to the guarantors and securitization. Ultimately, all along that food chain, credit scores are used and interpreted and analyzed, and and can have certainly great consequence in terms of the risk profile, or the perceived risk profile, of mortgages, and by extension, the securities that the securities that are backed by those mortgages. So today we have, again, two very senior folks from VantageScore. We have Rikard Bandebo, the chief economist, and Tony Hutchinson, who's the head of public affairs, joining with us. And before we get too far along in the conversation, why don't we? I want you to introduce yourselves and just give a little bit of the background, what you, not only what you do at VantageScore today, but maybe a little bit about your origin story that led you to where you are today as well. And we'll start with you, Rikard.
Thank you, William. It's a pleasure to be here. So I lead our strategic initiatives, but I also have an economic hat where I lead our economic research and several publications that we provide out to the marketplace. I've been fortunate. I've been with VantageScore for 4 years, and it's been one heck of a ride. I actually started as our chief product officer, where I used to oversee the teams creating the models and the technology teams that would deliver them. Prior to VantageScore, I had a lot of experience in different types of analytics companies. So I've been the CPO at analytics companies in HR, in location data, and I led analytics teams both at Deloitte and also at First Data Fiserv.
Great. And Tony?
Yeah, so thanks for having me. Great to be here with you, Will. It's always a pleasure to get out and talk about VantageScore to the marketplace. I've been with VantageScore for 3 years now. I'm in the Washington, D.C. office, so I have responsibility for our industry relations and government relations. And regarding that, it's really been focused for those last 3 years on driving adoption in the conventional conforming space so that we can get greater use throughout the entire mortgage ecosystem. I come to VantageScore from Freddie Mac, where I spent 10 years in that organization. I've lobbied for the National Association of Realtors on capital markets issues. And prior to that, I spent 10 years at Fannie Mae doing the grand tour of that organization. I tell all my friends that if I ever complete the full cycle and join Jenny Mae, that I'm going to win that gold-plated set of steak knives for doing the trifecta.
Is that what you get?
That's what I hear that you get. I don't think I'm going to get them because VantageScore has me.
I love it. I love it. I want to ask, either of you, as a kind of an origin story question around the VantageScore product, what is the again, the problem you're trying to solve here?
So, it's a really interesting and quite unique story behind how VantageScore got founded. So going back to the early 2000s, lenders were getting quite frustrated in the fact that there wasn't any competition really in the credit scoring space. And that was leading to a few things that were suboptimal. And one of the biggest concerns was that these models, they deteriorate over time. And so they wanted to always make sure that the latest and greatest models would be available so that they could obviously minimize their potential losses. At the same time, they're also very frustrated that the existing models missed around 20% of the eligible US population. That's a very large part of the population that they then can't sell their products to, whether they're mortgages, auto loans, or et cetera. And so they put a lot of pressure in the marketplace. They wanted something to happen. And unusually, what happened as a result of that was that they kept going to the credit bureaus. So they came together and created an independent joint venture, which became VantageScore. And that was founded almost 20 years ago. I think anniversary is in February, with the purpose of really driving innovation in the credit scoring space, in also being able to drive with that more competition, but also with a very clear mission to improve access to credit. And so that was how the genesis of VantageScore, and that started with VantageScore 1. And then since then, obviously, we've been working and we've grown enormously in terms of market share. We've launched several models, VantageScore 4, which is now being used in mortgage. We have other models that are used for other types of products like credit cards and others that have also been out for some time, and the newer ones as well. And so with that, what's interesting as well is that in other product areas where there has been competition in credit scores, we have grown tremendously. So if you look at the last earnings call from Experian, and their CEO, Brian Casson, actually quoted some of the statistics there. So for instance, in credit card, VantageScore is the most used credit score and has over 50% market share in use at originations for credit cards. Personal loans and fintechs is also an area where it's close to 50%. So in all those different markets where there's been open competition, we've obviously been thriving. And so now that is opening up in mortgage, it's great. There's going to be access to better scores, better models. And in turn, we're expecting obviously to have a great ability to drive competition, but also really help drive an increase in home ownership as well.
Yeah, I want to unpack a little bit of that. That's great background, but it's hard to overstate the importance of a credit score in the loan origination process, certainly. It is not the only, by far, not the only data point used to decision not only whether to give a loan, but how much to lend, right, by originators. But it is one of the most highly weighted factors that most originators use. And look, most sophisticated originators will also have their own proprietary scoring system, which they would certainly claim improves upon, the FICO or even VantageScore alone, and that's to be expected, I suppose, as a part of the competitive lending environment that we're in. But it is a very important aspect of lending. And VantageScore, as you mentioned, one of the important things that you mentioned that you were innovating for is, I would call it, the inclusion of more people in the lending ecosystem of the U.S. How is that being achieved without taking on more risk?
Well, so I think that's the key thing you just mentioned, right?
Yeah.
It's relatively easy to let more people borrow, but the question is, the real tricky aspect of that is how to let people borrow more, but without increasing the risk, right? And so obviously there've been a lot of advances over the years. One of the key advances is that the credit bureaus began being able to create time series data, or what's referred to as trended data.
Right.
And now in every other field, it has been found that time series data is typically very predictive and be able to evaluate future performance, right? And you can just imagine a simple thing that if we look, as opposed to how classic works, it just looks at a snapshot of a person's situation today, just today. Okay, irrespective if that person has been trending up or trending down in those various fields. By looking at 24 months of history, we're able to see a pretty good slice of how that consumer has been behaving over a longer period of time. And guess what? That is obviously very predictive. Being able to incorporate that is a huge factor in being able to build, and just in general, a much more predictive model. Additionally, there is new data that is being made available to the credit bureaus. It wasn't there in the 80s and 90s when the classic model was developed. And so, for instance, many people didn't realize this, but rental data wasn't used in those original models, right? But it is incorporated in the VantageScore models and including VantageScore 4. And what we found is that rental data, not surprisingly, is incredibly predictive of performance in mortgage, because it's typically a household's biggest outlay. So utilities data is included as well, and various other alternative data sources that, again, just improve that predictive performance. But then also at the same time, classic and all FICO models have certain constraints, and those constraints limit the number of people that are obviously able to be scored by them. One of the most limiting factors they have is that if you don't have any credit activity in the past 6 months that's being reported to the credit bureaus, they won't score you, right? And that, that was a constraint that may have made sense back in the 80s and 90s when you didn't have trended data and time series data, where you didn't have alternative sources of information like rental data and other forms of data, right?
Mm-hmm.
But now that we have these data and we've been able to validate this through our models, and obviously there have been tons of banks and others that have validated the improvement in accuracy of these models, right? But now that you have that, it is actually, you can change those constraints, right, without impacting risk. That's the key thing, okay? So just imagine this, right? Somebody has had, had great performance for 18 months, was doing really well. Then they just happened to pay off that car loan, which was the one thing they have, right? Or they happened to be in the military. They went and served abroad for 6 months, right? Or even longer. Okay, they come back and then all of a sudden they don't have a credit score, right? That's not a great situation for a lot of people, right? So when you have this additional data, when you have that time series data, you can actually very well evaluate a person's risk, right? To understand whether or not they're more likely to perform on these loans. So removing those constraints is, or changing these constraints is what enables you then to also score a lot more people, right? And what we found is, you can do this analysis, right, is that you then look at these different populations, those that are just scoreable by VantageScore and those that are not. And then you look at, well, how do they perform over time, right? If you look at, the score band they have and the default rates that they see, and they're, complete overlap. So you see a very, very high correlation there between both of those populations, which is exactly what you want to see. So that's basically telling you that they have the same risk profile, irrespective if they're only scored by VantageScore versus if they're scored by both scores.
Got it. And I think it's also worth pointing out, as I mentioned, FICO, you used the term FICO Classic. So it's a term of art used by the industry really to refer to the 3 versions of FICO that come from each of the credit bureaus, Experian, Equifax, and TransUnion, right? And it has been, Tony, this is why I want to bring you in, because you have firsthand knowledge of this. Those same versions have been in place for a very, very long period of time. They haven't really adopted. Now, that's not true of other asset classes in other ABS asset classes, consumer credit asset classes, where there is an array of different versions of FICO being used that accomplish different things, address different, let's say, problems or issues that are more lender specific, or call it target market specific. But that has not been true in the largest, right, arguably most important consumer credit segment in the U.S. So, Tony, maybe you can give some insight there as to the forces at play and why it's so slow to change.
Yeah, no, you're absolutely right. The mortgage industry likes consistency, if you will. And we've had these scores in place for a very long time. To your point, since the late 90s, to be quite honest, when Desktop Underwriter and Loan Prospector, both Fannie Mae and Freddie Mac's underwriting systems began to ingest them and then pass that information along to investors. So it's something that has been the standard. And oh, by the way, VantageScore was not around at that time. So it was the score, it was the only score that was in the market. Everyone began to use it, and they found value in using the score because it helped them absolutely process more loans quicker, which is what you wanted these tools to be able to do. But let's fast forward into the 2000s. We had a great recession which occurred. There was a lot of focus on how do you improve Fannie Mae and Freddie Mac across all of their systems and processes so that we wouldn't have a recurrence of what happened. There was a number of pushes towards legislation, but to be quite honest, most of the work that was done to improve Fannie Mae and Freddie Mac were on the policy side. So the regulator, along with Fannie Mae and Freddie Mac, put processes and procedures in place to really strengthen them, which is to do their best to strengthen them. The one place that no one thought about until 2 congressional members on the Senate side, and this was Senator Tim Scott of South Carolina and Senator Mark Warner of Virginia, got together and they said, hey, we need to make sure that the GSE is moving forward, and this industry for that matter, utilizes the most current technology. So they drafted the Credit Score Competition Act, which effectively was going to make Fannie Mae and Freddie Mac evaluate the marketplace, determine if there were new scores that could replace the classic, and if so, then implement them. Team, just realize that in 2018, they passed the Credit Score Competition Act so that Fannie Mae and Freddie Mac could move forward with new models. Well, fast forward to then October 2022. Now, this is during the Biden administration. So 2018, legislation passed. FHFA under the first Trump administration comes up with the guidance and guidelines for doing the evaluation. The Biden administration comes in, takes those guidelines and implements them. And in October of 2022, the head of FHFA, the Federal Housing Finance Agency, says, we have completed our work and determined that VantageScore 4.0 and our competitors' trended product will be the products that will be utilized by Fannie Mae and Freddie Mac to evaluate consumer mortgage loans and utilized. That was October of 2022. Now here we are 3 years later, 2025, and FHFA has indicated this past July of 2025 that we're going to move forward with the VantageScore 4.0 product immediately. Folks have had information that would allow them to do that, and for at least 3 years, they have known that this is coming. So what we try to do is we VantageScore have been going out into the marketplace saying, look, this is law. Regulation has been put in place to do this. Both Fannie Mae and Freddie Mac are moving towards this. We are doing everything we can to give you the information that you need to adjust your systems. Go and do that. And oh, by the way, come to us if you have any questions so we can help you. But I think what you're going to find now is that people are beginning to really move down that path because they see that the train is leaving the station, or actually has left.
I was just going to say, even with all of that lead time, years in the making, and all the communication and all the data that's available, I still feel like the industry, at least like I mentioned, the investors that I speak with were caught on their heels they feel like they're caught on their heels on that. I mean, you lay out a very good case for that information has been out there for some time. You should have seen this coming if you were paying attention, but I don't know if people were wishing it would go away, or they had other fish to fry in the meantime. I do want
less time to get astronauts on the moon.
Right.
That's right.
All right. So I do want to, Tony, I want to come back to one of the things that you pointed out that has come up in my conversations around the data. You mentioned going back to 2013 that's been put out there that allows people who want to, and there have been many people who have done this now, to analyze kind of side by side this, VantageScore FICO kind of comparison to quote unquote real world data, right? Going back to 2013. And that is true. And that allows a side by side analysis. The critique that I hear coming in is, well, that's all well and good, but that period of time happens to be one of the most benign credit periods, pandemic notwithstanding. Putting that aside for the moment, it is not the best, call it, testing ground for side by side analysis. What's VantageScore's response to that critique?
Yeah, so I think one of the challenges is that these new models, and that's not just true of VantageScore 4, that's also true of the other models that use trended data, is that trended data is only available going back to 2010. Unfortunately, due to the nature of how that data is created, it isn't possible to retro-create it going back further. And trying to use some kind of proxy just is not accurate and will give very misleading results. So, the bureaus have worked really hard to actually go back and create as much historical data as possible, because VantageScore 4 was launched in 2016. So it has been in the marketplace now for almost 10 years, and obviously it's grown and been used and validated. But for mortgage is a less known entity. So being able to go back even further has been obviously a beneficial thing to be able to do. But let's just be clear, all right? Yes, we don't have data going back all that way, but the general principle of a more predictive model performs better it will hold true, right? I think it's very hard for anybody to counter that. And when you have, the large banks and ratings agencies doing their independent analysis, like Bank of America, JP Morgan, KBR, even Bloomberg, all finding, and even Urban Institute, that, that the VantageScore 4 is more predictive, I think that in of itself is obviously a clear sign that, there is a system, a new score that will improve the risk and one of the current challenges with the existing scores. Okay, now also just remember this point, right? There was some great analysis done by the St. Louis Fed back in 2008, right? Where they found that the current score really had some shocking results back in 2007, right? And what they saw there was that actually the increase in delinquency rates among the highest scores was much greater than amongst the lowest score bands, right? So they saw that from 2005 to 2007, a 2-year period, the delinquency rates of the highest score bands, 700 and above on the classic score, right, quadrupled. Right, and they increased higher in absolute terms than the delinquency rates of the lower score bands. That is not how models are supposed to work, and that obviously led to massive amount of challenges and for the financial system that we then saw come through. So there is already a score that's in place that demonstrably didn't work as it was supposed to. So I think it's a clear sign that honestly it should happen sooner, but that a new score is needed to improve the systematic risk in the whole RMBS marketplace.
There's certainly been a lot of analysis of the great financial crisis, this being one element that, failed, I think, in some regards. So the reluctance to adopt something new, is this a classic devil we know kind of problem that you're encountering? There's resistance to the change because even though we know it isn't perfect, meaning FICO, that it is the devil we know. It's also, by the way, there's some, I imagine, and this is again my conversations with folks in the industry and being even at the rating agencies, I understand that there are some fairly sophisticated models that have been built around FICO, and the calibration of what FICO means to the risk profile of the loans, and then by extension the securities, is all pinned by some fairly complex mathematics. Long story short, it is not a trivial undertaking to ingest and incorporate a new score. I think there's some of that kind of, call it inertia or momentum, and as I characterize it, devil kind of response to this new entrant, VantageScore, being brought into the marketplace. Are you getting any of that feedback as well, or do you suspect that's also at play here?
I think initially there may have been some of that, but I'll tell you this. Lenders and big financials want to be on the cutting edge of both technology and information, and they want to be able to have the ability to predict performance, and they're going to go for the tools that allow for that. The larger players in the marketplace, they're moving toward this. They heard the Federal Housing Finance Agency say, hey, we're going to move forward. They saw the work that Fannie Mae and Freddie Mac were doing to begin that. And they have been putting systems in place and getting themselves ready so that when on day one, when FHFA says Fannie Mae and Freddie Mac can ingest a VantageScore, they're going to be ready to go.
Got it.
What we want to do is make sure that the entire ecosystem is ready for that. Specifically, a lot of the frontline originators that are going to compete with some of the larger guys. Nobody wants to see a market get captured. But if that happens, it happens. So we're out there doing our best to make sure that everybody, all of the originators up front, are educated on this and know what's coming and have a really good understanding so that they can enjoy the market and more importantly, serve the consumer out there that has not been served. At the same time, we go to those investors, and a lot of them may not know us on the mortgage side, but they know us on the asset-backed security side. If they're involved with Synchrony or Exeter or Toyota Motor Corporation, Global Lending Services, I know a lot of those are autos, but even the Opportunes and SoFis are out there. A lot of that collateral has a VantageScore associated with it, and they see that on all of the reports that they're getting on the performance of those assets that they're purchasing. So they know us. They just don't know us in mortgage or haven't really paid attention to us in mortgage, but they're going to. And I think that's the thing that's going to prevent any of those folks that may be a little hesitant to move forward. But to be quite honest, I see, if you would have asked me this question in 2023, I would have said, yeah, there's a lot of trepidation, there is inertia. Today, the inertia is not to not do it. The inertia is to get my system and myself ready so that I can hit the ground running and capture market and go after some of those additional 33 million consumers out there that I can service either in the mortgage industry, auto, or credit.
Yeah, and
Credit card.
it's so. I mean, you've painted a pretty clear, I think, and compelling dynamic here at play, and that is you have more data. You know, I think all of us, and certainly many of the listeners on this podcast, are kind of data-oriented analysts, and we know that we want more data, and that's exactly what is now present and has been for some time, but hasn't necessarily been put to work. I think you've painted a good story here that VantageScore is putting that data, significant data, trended data, to work, and should certainly, and I think has certainly, by the reports that you've cited, made better decisions around the credit risk dimensions of this population, addressable population of borrowers. And you've seen now your competitor, FICO, respond. I hope that's not an unfair way of characterizing it, but you've certainly seen them evolve, let's say, away from the classic into what they call the 10T product, which is using some of the very techniques that you've referred to, using this trended data, and certainly speaks to the same, strategy, I think, in terms of using that data that you've articulated on this in this conversation. Is that a fair way of characterizing the evolution of the landscape? And by the way, I should say this is what competition does, right? It to me, it speaks volumes when you stand back and think about FICO Classic hasn't really budged in so many years, and you have a new entrant, or the threat of a new entrant getting introduced, and there's a response by the stalwart, incumbent to improve their product. I'm sure that's how they're going to characterize 10T. It's an improvement upon the classic, right? And it wasn't done in a vacuum. They're looking around and seeing, what else now borrowers, investors have to choose from, and they're responding in kind. I think that's certainly a huge beneficial dividend to the marketplace, just to have that competitive friction in place.
I think that's true. I think it's good that there is that competitive tension because it will lead to improvements in the marketplace, as you're alluding to. I think, though, the one thing that's interesting is that, they haven't made that data available so that people can do comparisons, albeit versus older scores or against the VantageScore's. And so, I think that's a big question mark. Why not, right? We made our data available back in July of 2024. It's been out for a long time. That I think there's a lot of big question mark on a lot of people's heads. Is like, wow, if this new model is so good, why don't they allow people to do fair comparisons between these models? Like, we've made our data available. Anyone can go and use it and analyze it. Why didn't they do the same?
Well, what you mentioned about the idea of competition and driving further innovation, that's what we embrace. That's why we want to be in the mortgage market, and that's why we compete so well in the other markets that we're already in. And oh, by the way, that was the driving force behind the Credit Score Competition Act. The change is not for just a one-time, let's shift to these new models. The key is, how do you continue to keep improving them to capture the information on the consumer so that the market can have the most up-to-date information that's out there? And that's something that we embrace. We are going to continue to evolve as well. If they're better than us, then we're going to do the same thing they did and figure out how we improve ours. And we hope that they do the same thing versus us. That's what the market wants. And like I said, we embrace that fully. you'll see more of that. I believe that both the industry, meaning everyone from the originators all the way through the investors, and the consumer are going to benefit from that.
Yeah.
And what I'll say is that, we've seen also the anecdotal evidence that we've heard from those that have been able to look at both models has been that VantageScore 4 is superior. But I think the market won't want to do their own evaluation, and they're just waiting to be able to get the data to be able to do that. The other thing to just also put in the consideration, there's a couple of dynamics. First of all, you're talking about inertia in the system. Well, the classic model is going to get sunset. So, that means that it really does behoove the industry to get ready for new models. And, to begin evaluating VantageScore where everything's available right now will help them get that edge. And then when, at some point when both are available, they can then obviously make the decisions that will be most beneficial to them. But remember this, on top of performance, there's the factors such as, which one will be able to help them score more people or get more customers through the door, right? If they're originating, okay? And so 10T still has the same constraints as the old score. So we're still going to see that difference in 33 million. Or if you think about more of a mortgage rated basis, I know they've they've gotten rid of the threshold, but let's just say that a VantageScore 620, not exactly the same as a FICO 620, but not far from it, right? It's over 10 million people that are mortgage eligible and that would fall into that sort of constraint. So that's a lot of households and a lot of potential homeowners that could get access with really good credit histories that have been kept out of the system today. So a lot of mortgage originators are going to like for that, be interested in that. And then on the other side, you've also got a company that has stated in its earnings calls that its target is to drive the price of these individual scores to $100. Right. And so, I think originators have a lot of things going through their mind as they're trying to make the decision about which score is most appropriate for them over and above the predictiveness, which, again, we're pretty confident that will come up on top.
Yeah, that's another dimension to this that we hadn't really gone into yet. And I'm not saying we need to go into that much, but I mean, there is also, yes, the bottom line dollars and cents aspect of introducing competition to a service provider. So having competition there, I think, will be helpful as well in terms of driving down those costs, or at least putting a market driven cap on those costs. It might be a better way, as long as they're seen as being equivalent. I want to pick up on another question that's come my way that I suspect has come your way as well. And that has to do with, call it, disclosure around the use of either FICO 10T or VantageScore. And so there's some concerns like, well, if I'm an investor and I buy a security, at least in these early days, years of the introduction of both new scores, I want to know how much of the portfolio of the underlying mortgage pool is scored by either VantageScore or FICO Classic or FICO 10T. What are the proportions? Maybe they're all VantageScore, only a portion. In other words, there is at least some concern, rightly or wrongly, about the level of transparency and understanding that investors can do on an individual portfolio or pool of mortgages backing a bond. Is that something that you've come across in your discussions with investors or other market constituents? The disclosure aspect?
Well, I think Fannie Mae and Freddie Mac and FHFA have been addressing that with investors. They're the ones that are going to set the rules for that. And that's why in November of this past year, they began disclosing VantageScore for all of their existing RMBS in the marketplace. And they're going to do that going forward. So anything that goes out, even if it hasn't had a VantageScore associated with it or like originated with a VantageScore, it's going to have our score specifically so investors can get comfortable with how that score is going to perform over time. So they're the ones that are establishing the rules for that. And they're doing all the education, to be quite honest, to the investor community to get them ready to go so that they don't have any of those questions or concerns. But we haven't heard a lot of that, I would say, during a lot of the early listening sessions that FHFA had. Now, you guys need to recognize this. FHFA, for the better part of the last 3 years, since they indicated that they were making this change in 2022 have been reaching out to the industry asking, what are your concerns? How should we address those? And they have been doing everything to make sure, from making sure the data is available to putting out as much information as possible to both those that will originate, those that will have the systems that ingest and send forward information to the investor. That's the data that they need in order to move forward with this. I think they've done a yeoman's job at doing that. And they continue. They've been extremely transparent. I know that folks would want more information. That's to your point earlier about going past the Great Recession, but they're giving them everything they can and everything they have. So it really is on both the end users on either side of that equation, either at origination or at investment, to digest that information, to fully understand it, to get themselves prepared. Because to Ricard's point, this is not something that may happen. This is something that is happening. And if you're not on board, then you're going to be left behind.
Yeah.
I know investors, they're not going to be left behind. The folks that are the most sophisticated, they've gotten themselves ready.
Right.
And I know that just like I mentioned about those large financials, a lot of people were talking about that inertia. No, those guys have gotten themselves ready. So the market's going to move. The question is, for the people out there who are asking those questions, is why are you not ready?
I'd also say that we've invested a lot in putting together data sets, but also creating tools so that investors, ratings agencies, and others can look at all the past vintages, look at performance, and really begin to get very comfortable with how that score to odds ratio, which is so important for how they do their modeling, how that's been looking and how it's been evolving over time. And the bureaus themselves have been collaborating very closely to help them do retroactive scores of all their portfolios and working very closely to really put them in the best possible position to be able to make this change.
God. Let's zoom out a little bit. Zooming out from which model is better, FICO or VantageScore, and just kind of look at what's happening presently in the marketplace. And that is, two new models are being introduced to the market, the largest consumer credit marketplace in the capital markets sector in the capital markets. And it is causing people to ask questions that they haven't had to ask of themselves for years and years and years. Again, devil's advocate position here is, well, the fact that they have to ask the questions that they didn't have to ask, is that going to result in widening spreads, a wider risk premium? Again, this is not picking on VantageScore or FICO. It's just, this is a pretty big change when you're changing one of the fundamental elements of decision-making around either origination or investing. And is that change alone going to drive premiums wider? And I want to ask that question bluntly, because that, of course, is a headwind against the ambitions of, well, any policymaker, certainly, in that you want to bring down the cost of borrowing, certainly to improve mortgage rates and so on. Is that taking it the argument too far in your view, or is that legit?
I'd point out a couple of things.
Yes.
More predictive models should reduce that risk, and the arbitrage will drive that, right? So that's just mathematically, that's going to happen, right? I think the other thing I think is really important.
That happens. That you're right. I 100% agree. But that happens when? Because it doesn't happen right now, right? Because right now you don't know, or you can look at some studies, but a lot of investors remain skeptical even today. I guess that's the question.
But movements aren't created by the majority; they're created by those people who are trading, right? And if you find people who've figured it out and they have some money behind them and they want to make money, they will drive that change, right?
Okay. Yep.
So I think the second piece of this too, though, is you're absolutely right. People haven't been looking at this in depth for decades. And I actually think that's healthy. I think that now they'll begin to actually start forming a better understanding of how mortgage risk really looks like. For too long, for instance, a lot of people in the market have assumed that a 620 is just a 620 and it meant the same thing, or a 720 in one year is equivalent of a 720 another year, which is absolutely not the case, right? You see that credit scores are a relative measure of risk, not an absolute measure of risk.
Right.
And so now a lot of these actors, whether it's on the rating side or whether it's in the buy side, various different places, they're going to actually get a much better education on the nature of this type of risk. And as a result of that education, I think they're going to have a much better ability to evaluate risk of portfolios over time. So I actually think it's going to be an improvement because they themselves, are having to get much more familiar with all these dynamics.
Okay. Unless you had something more on the mortgage sector, I was thinking of now moving on to maybe some other sectors that, Rikard, you had rattled off a whole list of pretty big consumer sectors where VantageScore's had a presence and a pretty major presence at that. You mentioned credit cards I think you said 50%. Was it the Experian call that they had mentioned that? Tell us about that story, because I just, as an instructive kind of example of what could happen in the mortgage market when you introduce competition, maybe those sectors would serve as a good example. What was your experience in introducing and then adoption and so on and so forth?
Absolutely. I think one thing to also just remember, the point you made earlier about mortgage is that it is, credit score is one of several factors that's incorporated into the decisioning, right? And that makes sense. You have, when you're underwriting an average mortgage of over $300,000, you want to make sure you do the homework. And so spending $100 or $200 on having people manually review bank statements and stuff, and I know that's improved, but I'm just, bear with me here, right? Doing that work is something that just makes rational sense to do. When you start going and looking at other products like credit cards, at personal loans, where the loan amounts are much lower, the economics for having that kind of intensive review are very different, right? So they become even more reliant, I would say, on credit scores. And many of them, that is the factor they use, not just also remember in determining whether they give you that loan or not, or credit card, but also in determining the pricing and in determining, for instance, the amount of that loan or the amount of credit that you'd have access to on that particular card, right? And so for them, it's even more important, right? And also the dynamics are much faster moving because, they will see defaults faster. All these dynamics move at a much, much higher pace, right? And so they have a tendency to much more quickly evolve to what will be the best product for them. And so that, when they started seeing these models that were appearing that were enabling them to be more predictive, i.e. reduce their losses, enabling them to actually sell the same product to more people, that's obviously very important to these groups, then it just began a momentum, right? And I think a key part of that momentum in the credit card space was the old G Capital, now Synchrony, which decided to switch everything over, not just obviously the underwriting and the pre-qualifications, but even the securitization, everything. They flipped 100% to VantageScore and had great success. And they've talked about that on the earnings calls and what that's meant for them. And then I think when you see a few key stakeholders like that making that move, then you start seeing many, many more follow. And that's kind of how the pattern happened. And the same thing has happened, obviously, in the fintech and personal lending space. And also remember, in the fintech space, again, like credit cards, they're driven by like being the best technology, having the best math, right? That's so important to the success of those models, right? Or so the success of those businesses, I should say. And so for them, it was a no-brainer. Like, we're going to do more frequent evaluations. We're going to, analyze which one will have the best impact for us. And so again, in many of those industries, would see some of the leading players make that switch. And then you'd see the others realizing that they're getting a competitive advantage of transitioning to this score. We need to do the same. And even in auto, which is sort of, I would say, somewhere between like your credit card and your home purchase, because it is a high value loan. Like, obviously, it's not hundreds of thousands, but it's still in the tens of thousands. We've seen again there a really big transition, and like some of the biggest players like Toyota, Exeter, and others moving over to using us for their underwriting and originations.
It's a good point in terms of how dependent or more heavily weighted the credit scores are in those realms, those sectors. And yeah, the adoption bodes well, I guess, for your move into the mortgage sector if it's received similarly by the marketplace. You're making me think back. Before VantageScore was really on the scene, and I was looking at reported credit scores for credit card portfolios, for example. And, this is back in the day when there were many different versions of, say, FICO scores being reported, and people still treated them as kind of apples to apples in their analysis. And we knew better, but you didn't really have the tools. And I don't even know if the tools exist today to really put them on an apples to apples basis I don't know if the data is available to make those mathematical adjustments even today.
There is difference.
Yeah.
We publish all the data and we make it available in tools for free. So it's easy for them to be able to do this. And the bureaus work really hard. And they just announced also recently that, anyone who uses the other score can now pull the VantageScore for free to be able to do this type of analysis, which I think is a fantastic move. It just enables
really
more and more people to do this work without having to incur a fee to just do the due diligence. So we think that's very positive, and we think that'll actually even accelerate, not just in mortgage, but accelerate adoption in the other markets as well.
Okay, new frontiers for VantageScore. What is kind of top of the list of ambitions for 2026 and beyond? Good time of year to kind of take that question, I think.
So we've been developing new models. We're consistently innovating. With VantageScore 4, we obviously had, big increases in performance and new technologies that we use there. We even used sort of AI to create new clustering, to create segments so we're able to better score people. That was also a very key factor in improving predictiveness. But since then, we haven't rested on VantageScore 4, right? So one of the things that that industry has been asking for a long time, which we delved into, is also adding more data, right? And so one of the best forms of data that you can add to evaluate risk is bank account data, is open banking data, for instance. And so we developed a version of VantageScore 4 called VantageScore 4 Plus, where you can get a consumer to permission to have their different accounts. And it's not just their checking account, they can have their savings account, investment accounts, and other things, so that can get pulled in and then adjusting the score based on what we were able to identify from those accounts, right? Looking back again at a significant history of performance in those accounts. And that's really important because, look, as I said, I haven't said yet, but when you look at evaluating credit risk, by far the most predictive source is credit file data. But at the same time, you're not seeing everything, right? So you're not seeing how a person's income is coming in, what their outlays look like. You're seeing how their performance has been on other products, right? So by being able to bring in cash flow data, that actually is really, really valuable and predictive. Also, it enables you to, again, where people don't have a lot of information on their credit file, but they have a long history where you can look at their income, their outlays, they're performing on their different accounts, then again, you're able to do a much better job at evaluating those people who are sort of in the bubble. They don't necessarily have a good enough score to get the product they want, but at the same time, they haven't got any bad history in there, right? They just don't have enough history. So being able to pull in that data can really improve the ability to evaluate more fairly and accurately a lot more people. So
that's exciting.
Yeah, that's a cool advancement. And we've been working with many lenders who've been doing their pilots, and we're working with the bureaus to get this launched this year. So, and that's been, we've been really pleased with that. And there's a lot of receptivity to that in the marketplace. And I think the key here as well is making it so that it's easy to adopt, right? And so there are many different technologies to enable to do this. What we made sure we did was we were technology agnostic. So if a bank is already using
like Plaid or something like that,
a Plaid or a Finicity or whatever, that's fine. They don't have to then be forced to use a specific one. In this case, they can already use their existing rails they've set up, which aren't easy to set up, right? To then add to this. So we realized that it was really important not only to be able to have an accurate score, but also to make this really easy to implement. So we've been working hard on that. And then on the other side, outside of mortgage, And we developed a new score called VantageScore 5, and the predictive performance of that just is phenomenal. We started to use the best of AI and new methods to really be able to even just use the credit file data much, much better. And we've seen tremendous lift in credit cards and personal loans and even auto loans. And we're really excited. We have some of the largest institutions in the country that have been piloting that, and they're getting ready to switch over. So yeah, so a lot of great innovation and a lot of exciting new products that are coming to market with us this year in the bureaus.
Thank you for sharing that. When you say you're getting a lot of pop from the next version of VantageScore, what does that mean? Can you just put a finer point on that briefly? I mean, do you mean that the addressable universe is broader, as we mentioned in the mortgage with your 4.0 version, or is that better gradation of the existing population, so you're more accurately gauging the credit risk profile? Is it a bit of both? What do you mean by getting some pop in your latest Vantage?
Yeah, so both VantageScore 4 and 5 get improved performance predictiveness.
Okay, so that's same universe, but you now are putting them more accurately in the scale of 300 to 850.
Yeah, so all of our models score 33 million more than, for instance, than the models out there by FICO, right? So that's a standard.
Okay.
Again, we'll work more to get the few million that are still not yet scored, but that's a few million, and we're continuing to work towards that. But the bigger differentiation with these models is in terms of being able to be more predictive, but also when we look at the distribution of consumers that are scored, it's still far from perfect, right? If it was perfect, we'd have a group of people here that we know are going to fail and a group of people here we know are not going to fail, right? It would be that simple. But that's not the reality of what the distribution looks like. You have a lot of people in the middle. And as I was alluding to earlier, there are a lot of people that haven't yet got a score that necessarily enables them to get the type of loan or other type of credit product that they're seeking, not because they've done anything that is detrimental. They haven't got any public records or bankruptcies, or they've failed to pay on a loan. They haven't yet been able to build a sufficient credit history to be able to, in traditional means, get that, right? And so when you're able to improve predictiveness, not only are you being able to move a few people up and down, but you're able to push that middle hump sideways, right? So you can say, here are these group of people, and now we're actually seeing, they are actually more risky, and here's this group of people here, and they're actually less risky. So let's push them, towards the ends, and that really is where the rubber hits the road with lenders as they're trying to ensure that they can get the best performance with their products.
And then the other thing that you mentioned that I think is really exciting is the ingestion of bank, directly piping into people's bank accounts or brokerage accounts and getting that level of granularity to make good credit decisions or better credit decisions, or just a credit decision if you weren't able to make one before. I mean, that has been around and certainly employed by a lot of originators. Certainly the fintech industry has been all over that for many, many years now, and with great effect, right? I mean, they've been able to originate to borrowers, as you described, in very thin files. It's not a blemish as much as it is the absence of information through traditional routes, be the credit bureau, through what the credit bureaus captured generally. So you're able to see or infer, no small task for sure, but infer what people's monthly cash outlays are and cash, their income is, for example, and create like individualized budgets essentially from that information. And that wasn't available before. Certainly this technology was around only maybe 10 years ago, 15 years ago at the most, right?
So, and I mean, what we've seen is it has had a lot of great effect in two different ways. One, I mean, there were large banks who had already been using their own information on their own customers to evaluate risk. And they've been doing that for a while. The most sophisticated ones have been doing that for quite some time. And they've been finding up around 20% lift in predictive performance using the DDA data to help improve their evaluation of risk. So they already proved the case first, right? That worked really well. Then, as you alluded to, the technology enabled even those that didn't have their own history of customers' bank deposits to do that by using these companies, Finicity, Plaid, et cetera, right, to be able to do that. The challenge has been that, the most sophisticated have been able to dabble in that and have been able to see some good performance. But it's taken them a lot of investment, and they've had to have a lot of resources and the right types of people to be able to accomplish that. So it hasn't yet been a solution that could easily be adopted by the majority of lenders out there. And that's why having something like VantageScore 4 Plus, which it does the work for them. Also, the score has the same odds to risk ratio as VantageScore 4. So if they're already using VantageScore 4 and they then add 4 Plus, they don't have to adjust their underwriting criteria and all these other things. Whereas if they're trying to pull this in themselves, it becomes very complex, and they have to go through a lot more changes and calibrations to be able to adopt it. So again, I think that we're not saying that we were the first ever to use cash flow data, but what we've been able to do is to create a solution that can have mass adoption. And I think that's where, the real impact is going to happen.
Yeah, I'm smiling because this is actually not VantageScore per se, but just in general, this issue of access to bank account data, open banking, has been a point of contention. Late last year, I think Jamie Dimon, in fact, was quoted defending essentially his bank's obligation to protect this proprietary information, both for bank safety reasons and probably, I would assume, he didn't say this, for proprietary reasons as well, right? As you mentioned, this is valuable information that was accessible either very cheaply or for free. And so there's some friction, I think, in terms of what's the right price point and who should get access to that kind of bank information. Is it my individual, as an individual depositor, is it my information that I want to give to whomever I want to give to? Or is it, JP Morgan Chase, just to use them as an example, is it their information that they have a right to govern? And I think, the answer is probably somewhere in the middle. But
well, I think, the good thing there is that the 1033 rule is being looked at again. And that was, just for those who don't know, that's the CFPB created a rule the previous year, which actually was to facilitate and make it as easy as possible for fintechs to be able to use this data so that they could create value-added solutions for consumers. And there's a recognition from the current administration that there are a lot of industries that benefit from this. And so therefore, it still is something worthwhile. We're yet to see where they're going to land on where that rule will go. But obviously the signs are that it's going to happen, and it's probably going to be tweaked to hopefully be even more effective than the initial version was.
Well, listen, I want to wrap things up, but before we do that, Rikard, I would be remiss if at the top of the year I didn't ask you a credit question to look into your crystal ball for given how much data you must have access to, that you do have access to. Do you have any kind of parting words that can succinctly wrap up your forecasts for the consumer in terms of credit performance?
So, I think I'd be foolish to try to predict exactly what's going to happen this year, because there are so many things that are major that can happen that will have a profound impact on consumers and consumer credit health. But what I can tell you is what we've been seeing in terms of the trends and what that likely means, subject to excluding other major factors happening. And so on one side, a key thing that we've been seeing is that a lot of delinquency rates have been, also for most products, delinquency rates were rising consistently from around 21, 22. Okay. The good news is we've seen some of that stabilize. We're still seeing mortgages though going up, and we're still seeing, auto loans a little bit going up, but thankfully not as much as they were. On the auto loan side, they went up a lot.
Right.
But on the good side, we've been seeing, for instance, credit card delinquencies and personal loan delinquencies stabilize, or if not decrease, which I think is a good sign. Overall, though, we've been seeing this trend now for a number of years where we're seeing just more and more consumers, or households, I should say, struggling to make ends meet. And I think that trend, unless anything major happens, will just continue. We'll see what happens with the jobs reports today and other things. But, there's no sign yet that that's going to turn around. But at the same time, there's no sign either that it's going to massively degrade either. So I think we're just going to continue to see this trend of smaller amounts and more households struggling to make ends meet. And the implication for that is obviously that it'll be harder for them to be able to perform on some of their loans.
Okay. Well, thank you for that. I know it's hard to look into, these are difficult times to go out on a limb, given the volatility in the marketplace from day to day, week to week, and so on. So I appreciate that, sharing that with us. So thank you both very much. This has been really informative, and you took some hard questions and had great answers for them. And like I said, I stand back from this from my perspective. I like, I guess I'm predisposed to like competition in the marketplace. And so, I wish you the best, and nothing against FICO either. I hope they do well too. I think I would like to believe that the biggest consumer credit marketplace is big enough for two credit score providers to coexist, and hopefully have some good dividends for end users. So looking forward to watching how this story kind of plays out in the coming months and years to come. So best to both of you. And thanks again very much for joining the Consumer Credit Matters podcast. Thank you. And thank you, listeners.
Thank you. It's been a pleasure.
Thank you.